Marcus and Daniel are both 30 years old. They both live in Dallas. They both earn $80,000 a year before taxes. They both have $25,000 sitting in a savings account. Neither has any debt beyond a small car loan. Neither receives an inheritance. Neither wins the lottery. They start from the exact same financial position. And today, they both make a decision they believe will build generational wealth. Marcus decides that real wealth comes from owning assets his children can see and touch. He buys a rental property. Daniel decides something completely different. He ignores the dream of becoming a landlord. Instead, he invests consistently into a low-cost stock index fund and focuses on building financial assets his family can inherit. Ask either one who's making the smarter decision, and they'll both tell you the other guy doesn't get it. They're both wrong. Because the biggest mistake isn't choosing real estate or choosing the stock market. The biggest mistake is thinking generational wealth begins with an investment. It doesn't. It begins with understanding how money behaves over decades instead of months. By the end of this video, one decision creates a family tree that keeps producing wealth long after its owner is gone. The other creates something that looks impressive today but quietly leaks money in ways almost nobody talks about. And the gap between those two outcomes isn't what most people imagine. To keep this comparison fair, Marcus and Daniel have identical incomes, identical savings, identical ages, identical careers, and they live in the same housing market. No lucky breaks. No special connections. Just two ordinary people making two ordinary decisions. Now let's run the numbers. Marcus finds a small rental house listed for $250,000. He uses his entire $25,000 as a 10% down payment. Closing costs add another $6,000, so he rolls part of them into the mortgage and covers the rest with cash reserves. After financing, he owes roughly $225,000 on a 30-year mortgage at 5%. His monthly mortgage payment for principal and interest comes to about $1,420. Property taxes average around $420 a month. Insurance adds another $150. He also budgets roughly $200 every month for maintenance because roofs, plumbing, and air conditioners don't care about your financial plans. His total monthly carrying cost lands close to $2,190 before accounting for vacancies or unexpected repairs. Fortunately, the property rents for $2,400 a month. On paper, Marcus smiles. $200 of positive cash flow. Sounds great until you subtract everything else. Meanwhile, Daniel takes the same $25,000 and invests it into a globally diversified, low-cost stock index fund tracking thousands of companies. Instead of buying one property in one neighborhood, he's effectively buying tiny ownership stakes in businesses spread across dozens of industries. Then he commits to investing $1,000 every month. No tenants, no repairs, no property inspections, no phone calls at midnight because someone's water heater exploded. His investment account doesn't look impressive to his neighbors. There's no house to drive by, no for rent sign, no keys hanging from his belt. It's just a number on a screen. And that's exactly why most people underestimate it. One choice feels exciting, the other feels invisible. Feelings and math are two very different things. Now here's something almost everyone misses. When people talk about generational wealth, they usually talk about what they own. Very few talk about what survives them. That's an important distinction. A luxury car doesn't become generational wealth. Neither does a larger television. Even an expensive house isn't automatically generational wealth if it requires constant financial support from the next generation. Real generational wealth produces income without demanding that your children rescue it financially. That's the standard both Marcus and Daniel have to meet. Let's fast forward 1 year. Marcus collects almost $28,800 in annual rent. Sounds fantastic. But now reality begins sending invoices. Property taxes total roughly $5,000. Insurance costs about $1,800. Routine maintenance reaches nearly $2,800. The property sits empty for 1 month after a tenant moves out, reducing rental income by approximately $2,400. Finding a new tenant requires advertising, cleaning, and minor repairs costing another $1,200. Suddenly, almost $12,800 disappears before even discussing the mortgage. His mortgage payments total about $17,000 for the year. Of that amount, only around $2,500 reduces the loan balance. The rest goes toward interest. That's normal during the early years of a mortgage, but it's a detail many first-time investors overlook. On paper, Marcus owns a rental property. Sounds great, until you subtract everything else. The good news? Home prices in his neighborhood appreciate by roughly 4%. His property increases in value by about $10,000. His mortgage balance also falls slightly. His net worth rises, just not as dramatically as social media would have you believe. Now let's look at Daniel. His initial $25,000 grows with an assumed long-term average annual market return of roughly 10% before inflation. That's close to the historical average annual return of the S&P 500 over many decades, although actual yearly returns vary significantly. His starting investment becomes approximately $27,500. Then his monthly $1,000 contributions add another $12,000 during the year. Thanks to market growth throughout the year, his investment account finishes at roughly $40,700. No vacancies, no maintenance bills, no insurance claims, no emergency plumbing repairs. His account simply compounds, quietly, almost invisibly. And that's exactly why many people ignore it. Now, before anyone rushes to declare Daniel the winner, remember something important. Neither strategy has been tested long enough. 1 year proves almost nothing. Markets can fall, property values can fall, interest rates can change. This story isn't about one lucky year. It's about what happens when decades begin stacking on top of one another. 3 years pass. Marcus feels more confident than ever. His tenants have mostly stayed put. Rent has gradually increased to around $2,600 per month. His property is now worth approximately $281,000 if prices continue appreciating at around 4% annually. His mortgage balance has fallen to roughly $216,000. On paper, his equity approaches $65,000. Friends tell him he's becoming wealthy. They see the property value. They rarely ask about the expenses. During those same 3 years, Marcus replaces an aging HVAC system for nearly $8,500. A plumbing issue costs another. Insurance premiums increase after severe storms push up regional claims. Property taxes rise alongside home values. None of these costs make exciting social media posts, but every one of them affects the final return. On paper, that's $281,000. Sounds impressive, until you subtract everything else. Meanwhile, Daniel continues doing something painfully boring. Every payday, another automatic investment. No guessing, no market timing, no emotional decisions. His total personal contributions now equal $61,000. The original $25,000 plus $36,000 invested over 3 years. Assuming long-term average market performance, his account grows to roughly $72,000. Nothing about Daniel's strategy feels dramatic. No celebrations, no congratulatory phone calls, no neighbors asking to see his investment account. But here's where something quietly changes. Marcus spends part of every weekend thinking about one property. Daniel spends almost none of his time managing thousands of businesses working on his behalf around the world. Time itself begins becoming part of the investment. Most people never assign a dollar value to that. They should, because while Marcus is managing his asset, Daniel is free to learn a new skill, earn a promotion, build a side business, or simply spend more evenings with his family. Generational wealth isn't measured only by money. It's also measured by the freedom your money gives you. And we're only 3 years into a 20-year story. By year 5, something happens that almost nobody sees coming. It doesn't make headlines. It doesn't happen overnight. But it's the moment where the maths quietly begins shifting. And it's the point where Marcus and Daniel's 2 paths start telling completely different stories. By year 5, Marcus feels like all the hard work is finally paying off. The monthly rent has climbed from £2,400 to roughly £2,750. The property itself has appreciated to around £304,000 if home prices continue growing at approximately 4% per year. His mortgage balance has fallen to roughly pound 209,000. On paper, his equity now sits near 95,000 pounds. If you stop the comparison right there, Marcus looks like the obvious winner. He's nearly doubled his equity. He owns a physical asset. He has leverage working in his favor. And that's exactly why so many conversations about generational wealth end too early, because equity isn't the same thing as spendable wealth. During those same 5 years, Marcus has also written checks that almost nobody remembers. Property taxes have increased alongside rising home values. Insurance premiums have continued climbing. Routine maintenance averages about £2,500 a year. A new roof costs £13,000. Fresh paint between tenants costs another £2,400. A fence replacement adds £3,200. One tenant leaves unexpectedly, creating a 6-week vacancy that costs almost £4,000 in lost rent and turnover expenses. On paper, that's £95,000 in equity. Sounds fantastic, until you subtract everything else. Now look at Daniel. He never increased his monthly contribution. He simply stayed consistent. His original £25,000 plus 60 monthly investments of £1,000 have totaled £85,000 in contributions. Assuming an average annual return close to 10%, his investment account has grown to roughly £116,000. Notice something interesting. Marcus owns more gross assets. Daniel has more liquid wealth. If Daniel needs £20,000, he can usually sell part of his portfolio within days. If Marcus needs £20,000, he probably needs to refinance, borrow against the property, or sell the entire house. Liquidity isn't exciting until life happens. Then liquidity suddenly becomes priceless. Now let's jump ahead to year 10. This is where the story quietly changes. Marcus's property has appreciated to roughly £370,000. His remaining mortgage balance has fallen to around £186,000. His equity has climbed to approximately £184,000. That number gets attention. Friends congratulate him. People tell him he made the right choice. Social media celebrates screenshots like these every single day. But here's the question hardly anyone asks. How much of that £184,000 could Marcus actually keep if he sold tomorrow? Selling isn't free. A real estate commission of around 5% could remove roughly £18,500. Closing costs might add another £4,000. If the property has generated taxable gains beyond applicable exclusions, taxes may apply depending on ownership structure and local law. Repairs requested by the buyer could easily cost another £5,000. Suddenly, that impressive equity number starts shrinking again. On paper, that's £184,000. Sounds amazing, until you subtract everything else. Daniel reaches year 10 with something much less exciting to look at. His investment account. His contributions now total £145,000. Assuming long-term average market performance, his portfolio has grown to approximately £245,000. Nobody drives past his investments. Nobody asks to take pictures beside them. But his money has been quietly purchasing ownership in thousands of profitable businesses. Many of those companies increased earnings. Many paid dividends. Many expanded globally. Daniel didn't have to negotiate leases. He didn't replace roofs. He didn't answer emergency calls. His investment simply kept compounding. Now here's the flip point. For the first several years, Marcus appeared ahead because leverage magnified his property gains. But leverage works both ways. Imagine property prices fall just 10%. Marcus's £370,000 property suddenly becomes worth around £333,000. His equity falls from roughly £184,000 to about £147,000 almost overnight. A 10% decline in the property created roughly a 20% reduction in his equity because debt amplified the movement. Leverage accelerates gains. Leverage also accelerates losses. Daniel's portfolio can absolutely decline too. History tells us stock markets experience corrections regularly, but Daniel doesn't receive a call demanding additional cash simply because the market had a bad month. Marcus could face refinancing challenges if interest rates rise or property values weaken. Different risks, different consequences. Now let's talk about something almost nobody discusses. Everyone loves talking about returns. Very few people talk about friction. And friction quietly determines whether wealth survives long enough to become generational. The first hidden layer is vacancy. Most investors calculate 12 months of rent. Real life rarely delivers 12 perfect months every single year. Even one vacant month can reduce annual rental income by 8%. On a property renting for £2,700 a month, that's almost £2,700 gone before paying the mortgage. The second hidden layer is capital expenditures. Roofs wear out, water heaters fail, driveways crack, air conditioning systems stop working at the worst possible time. Financial planners often recommend budgeting around 1% to 2% of a property's value annually for major long-term replacements. For a £300,000 property, that's £3,000 to £6,000 every year, whether you spend it this year or save it for the years ahead. The third hidden layer is property management. Some investors manage everything themselves. Others hire professionals. Management fees commonly range between 8% and 10% of collected rent. On £32,000 of annual rent, that's roughly £2,600 to £3,200 every year. If you're doing the work yourself instead, understand something important. You're paying with time instead of money. Time has value too. The fourth hidden layer is insurance inflation. Insurance costs don't stay fixed. Natural disasters, construction costs, regional claims, all of these can push premiums higher over time. Many investors budget using today's insurance bill instead of tomorrow's. The fifth hidden layer is opportunity cost. This one never arrives as an invoice. It's invisible. Marcus invested nearly all his available capital into one property. Daniel spread his money across thousands of companies operating in technology, healthcare, manufacturing, finance, consumer goods, energy, and more. Concentration can create exceptional returns. Diversification can reduce the damage when one area struggles. Neither is automatically better. But opportunity cost deserves a place in the calculation. Now let's make something absolutely clear. If I only showed you the downsides of rental property, I'd be doing exactly what every stock market influencer criticizes real estate investors for doing. Real estate has genuine advantages. Leverage allows investors to control a much larger asset with relatively little upfront capital. Rental income can rise with inflation. Property owners may benefit from valuable tax rules depending on their country, ownership structure, and individual circumstances. A well-selected property in a growing area can produce outstanding long-term returns. Some investors use strategies like house hacking, where they live in one part of a property while renting out the rest, dramatically reducing housing costs. Others complete successful renovations that increase both rent and property value. Those are real advantages. Ignoring them would make this comparison dishonest. Now let's be equally fair to Daniel. Stock investing isn't effortless emotionally. The biggest risk often isn't the market. It's the investor. During severe bear markets, broad stock indexes have historically fallen 30%, 40%, and on rare occasions even more before eventually recovering. Many people panic. They sell at exactly the wrong time. Then they miss the recovery. Daniel also has no leverage multiplying his gains. His portfolio grows steadily, but usually not explosively. And unlike a rental property, his investment account doesn't generate a place for someone to live. So when does Marcus actually win? Quite a few situations. If he buys significantly below market value, if the neighborhood experiences unusually strong population growth, if rents increase much faster than expected, if he self-manages efficiently and keeps maintenance unusually low, or if favorable tax treatment substantially improves his after-tax return. Those aren't fantasies. They happen. Likewise, Daniel wins when he remains invested through market downturns, keeps costs extremely low, and allows compounding to work uninterrupted for decades. Neither strategy guarantees success. Execution matters far more than the headline investment. Because by year 20, the conversation isn't really about houses or index funds anymore. It's about something much bigger. It's about whether the wealth you built can continue serving your children without demanding that they constantly rebuild what you started. By year 20, Marcus is 50 years old. Daniel is 50 years old. Neither one feels rich. That's one of the strange things about wealth. It usually arrives quietly. Marcus's rental property is now worth approximately £548,000, assuming an average annual appreciation of about 4%. His original £225,000 mortgage has been paid down to roughly £120,000. On paper, his equity is close to £428,000. That's an incredible improvement from where he started. But let's finish the maths. Over 20 years, Marcus has replaced another HVAC system. He's resurfaced the driveway. He's repaired plumbing more than once. Insurance has continued rising. Property taxes have increased alongside home values. He's experienced several tenant turnovers, months of vacancy, legal paperwork, and routine maintenance that simply comes with owning physical property. Conservatively, those ongoing ownership costs could easily total another £120,000 to £180,000 across 2 decades, depending on the market, inflation, and the condition of the property. If Marcus decides to sell, he also faces selling expenses. A 5% real estate commission on a £548,000 property is roughly £27,000. Closing costs might remove another £5,000 to £8,000. Capital gains taxes may apply depending on ownership structure and local tax rules. Suddenly, that headline number begins shrinking again. On paper, that's £428,000. Sounds incredible until you subtract everything else. Now let's visit Daniel. He never found the perfect stock. He never chased cryptocurrency. He never tried to predict recessions. He simply kept buying a diversified, low-cost index fund every month. His original £25,000 investment remained invested. He continued contributing £1,000 every month for 20 years. That's £240,000 of additional contributions. His total personal investment equals £265,000. Assuming an average annual return close to 10%, his portfolio grows to roughly £930,000. Notice something fascinating. Daniel didn't contribute £930,000. The majority of that balance came from growth. That's compounding doing the heavy lifting. Money earning money, then those earnings earning even more money, year after year, without asking permission, without working overtime, without negotiating rent. Now imagine something even more interesting. Instead of stopping at year 20, both men continue for another 20 years. Marcus finally pays off the mortgage completely. Rental income increases because there is no longer a mortgage payment. That's a genuine advantage. Cash flow improves dramatically. Daniel continues investing. His portfolio continues compounding. Neither strategy suddenly becomes bad. The gap simply continues responding to mathematics. And that's the lesson most people miss. Generational wealth isn't about reaching one impressive number. It's about building an asset that survives long enough to outlive you. Now here's the lever that changes everything. Remember Daniel's monthly contribution? It was £1,000. What if it became £1,200 instead? Just an extra £200 every month. Not £2,000, not £5,000, just £200. Over 20 years, that small increase could grow into well over £150,000 of additional wealth, depending on market returns. Most people spend months searching for investments that outperform the market by 2%. Very few realize increasing their savings rate often has a much larger impact. Small behaviors repeated for decades usually beat brilliant ideas repeated for 6 months. Now let's ground this in real data. According to the Federal Reserve's Survey of Consumer Finances, the wealthiest households tend to own multiple types of assets rather than relying on just one. Diversification is common, not exceptional. The IRS also provides tax-advantaged retirement accounts that allow investments to grow under favorable tax treatment, subject to contribution limits and eligibility rules. Meanwhile, the S&P 500 has historically produced approximately a 10% average annual return before inflation over very long periods. Although future returns are never guaranteed and individual years vary significantly. None of those are opinions. They're simply facts available from public institutions and long-term historical data. So if your goal really is generational wealth, what should you actually do? Start with step 1. Build a financial foundation before chasing investments. Maintain an emergency fund covering at least 3 to 6 months of essential expenses. That prevents temporary emergencies from forcing permanent financial mistakes. Step 2. Invest consistently before trying to invest brilliantly. Automate your contributions. Whether it's every payday or every month, consistency matters more than perfect timing. Missing the market's strongest recovery days has historically reduced long-term returns far more than investing through ordinary volatility. Step 3. Own assets that produce income instead of liabilities that consume it. That could mean rental property. It could mean diversified index funds. It could mean profitable businesses. The asset matters less than whether it continues producing value long after the initial purchase. And finally, teach the next generation. This is the part almost everyone skips. Imagine Marcus leaves his son a £500,000 property. If his son doesn't understand budgeting, debt, taxes, maintenance, insurance, and investing, that property may be sold within a few years. Now imagine Daniel leaves his daughter a £900,000 investment portfolio. If she doesn't understand compounding, diversification, and emotional discipline, she might sell everything during the first bear market. Money without knowledge rarely survives. Knowledge without money eventually creates wealth. When you combine both, that's when generational wealth actually begins. Remember Marcus and Daniel? They both walked away believing they'd made the smarter choice. Marcus believed owning property automatically meant he'd created a legacy. Daniel believed investing in the stock market automatically guaranteed financial freedom. Neither one actually ran the full numbers. Marcus underestimated decades of ownership costs. Daniel underestimated how difficult it can be to stay invested when markets fall. The winner wasn't determined by the investment. The winner was determined by behavior, by consistency, by understanding the maths before believing the headlines. Because the real trap isn't real estate. And it isn't the stock market. The real trap is making one of the biggest financial decisions of your life based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. The families that build lasting wealth usually aren't the ones making the loudest financial moves. They're making the most consistent ones. They're buying productive assets. They're avoiding unnecessary debt. They're teaching financial literacy to the next generation. And they're giving compounding something incredibly rare: time. If you're wondering what happens when someone combines both strategies, using rental property for cash flow while simultaneously building a diversified investment portfolio, that's a completely different conversation. And it's one that might surprise you even more. So before you make your next financial decision, ask yourself one simple question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden maths behind the financial decisions you face every day, so you can make smarter choices with confidence. Until next time, keep running the numbers.